The following program is produced and sponsored by you, the TBN Partners, and is only made possible through your generous support.
Thank you for tuning in to Joy in Our Town. I'm your host, Monique Dennis, and this is where we talk about different issues that affect the South Florida region. Issues from housing to crime to our very youth. But today we're going to focus on a very important subject, and it deals with housing, reverse mortgages. Today with us I have Franklin Nickens from Community Development Outreach, as well as Richard Rash from the Transcontinental Lending Group. He is a certified reverse mortgage specialist, and Franklin Nickens is the executive director of CDO, other known than CDO. Welcome.
Thank you.
How are you gentlemen today?
Great.
I'd like to thank you for coming in to Join Our Town. Well, let's get right into it. What is a reverse mortgage?
A reverse mortgage is a government-sponsored loan for seniors 62 years of age and older that can unlock the equity in their home without having to make monthly payments. And there are no credit requirements, there are no income or asset requirements. So really the key component here is the need to own their home, preferably free and clear, so that they can take as much equity out to do with it whatever they please.
Okay, excellent. Who is eligible for a reverse mortgage?
Any senior who's 62 years of age and older will typically qualify as long as the home is their primary residence. Now, they can have a mortgage on the property, but the ideal person would be one that has no mortgage, that the property is free and clear.
Okay. Now, we hear different pros and cons about reverse mortgages. Some people say that once you die, you lose your house, and the house is now in the hands of the mortgage company. But how does reverse mortgages benefit the person, the elderly person?
There's a lot of myths and misconceptions, and most of the things that you just said are not true. This, like I said, is a government-sponsored loan. So the last time I checked, the government is not in the habit or in the process of taking property away from people. This program was created to allow seniors to remain in their home in their later years rather than displace them. So with that said, basically the client keeps the property, and it is a mortgage just like any other mortgage. The only difference is, instead of making monthly mortgage payments to the bank and building equity in their property, the mortgage actually works in reverse, hence the name. Okay. So we are giving them the equity up front, and in reverse, the interest is actually being added to the principal.
Okay, Franklin.
I want to add to that.
Yes.
And this is why I like the reverse mortgage. This is why I work with Ricky Rash. We have a lot of seniors out there who are hurting. Okay, their medical bills are far beyond what the expectations were. Or either the husband is no longer in a position to provide, or things like that. But they're sitting there with all that equity in the home. They have no kids to come in and help them, but they still have all this equity they're building. Why are they saving it for their kids when they can utilize it to take care of their personal needs now, so that they're not calling the church up, so to speak, begging for money because they can't pay the light bill because they've got all these medical bills. They've already built the equity. Now it's time to utilize it. And that's why I like the reverse mortgage.
Okay, what happens when the person dies?
Okay, Ricky.
When the actually the loan is due and payable when three things occur. Either the borrowers move out of the property and it no longer becomes their primary residence. For instance, they might move in with their children or move into elder care. The second instance would be if they sell the property. Once they sell the property, obviously the loan gets paid off, just like any other mortgage. And then the third instance is what you were referring to. The loan is actually due and payable when the last remaining spouse passes away. So if you have a husband and a wife, one passes away, the other is still alive, he or she would still retain the benefits of the reverse mortgage until that person passed away.
Okay. How much cash can someone receive? South Florida, we love the subject of money, economics, cash. how much cash?
That's a great question. We get this all the time, and
yes.
the answer is it depends.
It depends.
These loans are basically calculated like life insurance actuarial tables. So the older somebody is, generally, the more money they'll qualify for and receive. So somebody who's 62 will definitely not receive as much money as somebody who's 82 or 92 or 102 for that matter. So we've seen people receive as little as 40 to 45% of their home's value. We've seen people in their 90s and hundreds receive up to almost 85 or 90% of their home's value. So it really depends on several factors, but the most important one is their age.
Okay, the age. Now, age meaning that they've been in their home for that long period of time, or, you know?
No, the actual age of the borrower.
Okay.
And we qualify on the youngest of the two borrowers. So if you've got somebody who's in their 90s and somebody who's in their 70s, we would have to qualify the person in their 70s.
Okay. Franklin, how does CDO inform those individuals about reverse mortgages?
Well, the biggest issue that we deal with as far as seniors are concerned, they're calling in with needs. They're looking for someone to help them repair their home, or they're looking for someone to come in and to sit with their spouse because they need to go out and run errands and things of that nature. Or they're going out trying to do a part-time job and still try to take care of the homebound spouse. And we're looking at these seniors and we're saying, okay, have you looked at other viable options that are available to you as far as a reverse mortgage and pulling out the equity so that you can stay home? And the misconception is this: all they want to do is steal my home. I said, okay, I need to research that as CDO and find out what's available to these seniors, and then make sure we point them in the right direction with the right people. There are people out there doing stupid stuff. That's within the industry. So you need to make sure these people are reputable, first of all, okay? I've known Transcontinental Lending Group for a long time, and I know that there are people of integrity. So that's why we deal with them first and foremost.
Okay, excellent. How, and this question is for you, Richard, how is the loan repaid?
Like I said, the loan's repaid when the client either passes away, sells the property, or moves out. At that point, the lender is going to calculate any outstanding principal and interest. Typically, seniors will will their property to their heirs, either their children or a close family member. And at that point, the bank's going to contact the heirs directly, explain to them what the outstanding principal and interest is due. And in most cases, the heirs will end up selling that property on the open market. And at that point, the loan will get paid from the proceeds of the sale.
Okay, excellent. Now, I see here, what are the client's cash options?
There's four basic options when somebody obtains a reverse mortgage. The first one would be like in a cash-out refinance for a forward mortgage or a typical mortgage situation. The person would go to the closing and get a lump sum of cash. At that point, they take the money and do with it whatever they want. This is an unrestricted use of proceeds. If they didn't have an immediate need for a lump sum of cash, because in some cases it could be several $100,000, they could take the money in the form of a fixed monthly payment, almost like an annuity. But these are fixed monthly payments, tax-free, that continue for the rest of their life. The third option would be they could take a line of credit. And it's not to be confused with a home equity line of credit that you would receive from a bank.
Yes.
This line of credit sits with the lender, and the borrower can tap into that equity whenever they want. They would contact the lender, and the interest is only charged on the amount that they borrow.
Okay.
So somebody could have several $100,000 at their disposal, but they're only being charged interest on what they borrow. The unpaid portion of the balance can actually grow over time. Okay. So it's a great feature for seniors.
Okay.
And then the fourth option is they can take any two of the options that I just mentioned and combine them. So somebody can obtain a small cash lump sum at the closing with some fixed monthly payments, or leave the rest in that credit line.
So you can combine them as
There's a lot of flexibility, yes.
Okay, excellent. And out of all of those four options, what is the most popular?
I would say the most popular option is the line of credit.
Okay.
Because seniors don't have that immediate need, but they need that money just in case, almost like a safety or a reserve. And there are a lot of things that, you know, either families or the government can't necessarily bail the senior out. So let's assume that a senior takes that line of credit option, the money's sitting there. If another hurricane should happen and they want to make the repairs right away and they don't want to wait for the insurance company to bail them out, they can take that money and use it for that type of purpose.
Okay.